Powell testimony comes, Powell testimony goes, and we're left unchanged on the policy outlook for the Fed, and stocks can't make hay of it. An interesting day in markets today, to be sure, but the focus on macro remains firmly intact because we still have a ton of event risk facing these markets. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to take a look at the next big inflection point here, a monetary policy announcement from the European Central Bank and how it fits within this whole will the Fed or won't the Fed and global central banks more broadly bail out this stocks rally and keep it moving. Because here, we might well begin to see the start of this rate cut cycle that everybody has been hoping for, at least get admitted openly. And in that, we might see some interesting price action all around. So what we're going to do here is look at how the euro has behaved in the wake of what happened today with Jay Powell, and then consider where opportunities might be now that it's gotten to where it is. So this was the price action intraday, and these are 6E futures, so the euro exchange rate against the US dollar. And what you see here is a very kind of straightforward, bad is good kind of day. Now, this is very interesting. Interesting because for the US, we've arrived at 80 basis points being priced in for the rate cut path for this year. So we've arrived at where the Fed said it should be back in December. Of course, back then, the markets thought that the Fed was going to do much more, double that, in fact. Something more like 150, 160 basis points in cuts. So 6 cuts rather than 3. And of course, the story then since the beginning of the year has been of U.S. economic data coming out stronger than expected, and that number of rate cuts coming down with that data. And the market's basically going, well, 100 basis points is still more than 80. We're still good. And then more good data comes out, and you go to 90. And the market goes, well, 90 is still more than 80. We're still good. The money is still going to be cheaper than the Fed is telling us. And now we arrive at 80. And the data that starts to suggest that maybe it should be less than that starts looking like bad news because the markets don't want to be on the tighter end of the Fed. That would mean that, in fact, monetary conditions are relatively restrictive when you compare them to what the Fed thinks they ought to be. And that, of course, makes risky assets less attractive. So what we've seen since really last week was the PCE data doesn't surprise higher. Markets like it. The ISM data surprises lower. Markets like it. Earlier this week, even only a brief pop higher, but softer ISM services data. Markets liked that. It was back in force today. ADP data, the estimate of the private sector payrolls growth that typically runs ahead of the official numbers, those are due Friday, that came in a little bit softer than expected. 140,000 jobs added to private payrolls versus 150,000 expected. And you can see here, right as that data came out, the dollar gets hit. It gets hit because stocks like it, they pop a bit, and the euro rises in sympathy. But then, of course, you get the testimony, the first day of testimony from Fed Chair Jerome Powell. He shows up in the House. He's going to do the same thing in the Senate tomorrow. The Q&A is going to be different in the Senate, so we'll see how that goes. But the prepared remarks should be about the same. he manages to walk the tightrope and keep the outlook for this year unchanged as far as the markets are concerned at about 80 basis points. So the baseline for this year stays steady. Stocks manage to pop on that until they ultimately fade into the end of the day, which incidentally we can see saw the dollar claw back some of its losses. But where you get the real punch for the dollar here and the real lift that the euro enjoys is in a comment that Powell makes where he says that if the economy evolves as the Fed hopes, interest rates will need to come down significantly over the coming years, with a plural on the years, implying that it's not just this year. We're going to keep cutting next year if the Fed gets its way. And so this, of course, becomes a story about the attractiveness of yields for the dollar relative to other currencies. And so not surprisingly, its most liquid, most significant counterpart, the euro, gets a nice lift higher. And the dollar is generally lower on the day until that fading in the stocks move comes in the latter hours and it manages to claw back a bit of lost ground. But from here, the euro finds itself in an interesting position. If we look at the overall setup here, we still have a trend higher from about October through to about the first month of this year that has been broken. So this larger move higher, that's been overturned. This initial move lower clearly has also been overturned. But if we see where the euro ultimately landed when it finished the day, it struggled to overcome this high, and it's right back to the place where it broke through in the first place. So what we're seeing is perhaps about as textbook as you get, at least technically, a break, retracement to retest, resumption. So that we were unable to get through this resistance may very well be the first incremental step in a setup that establishes a top and gives us the beginning of what is the next big leg down for the euro. We might very well be at the turning point right here. And the ECB and what it says about interest rates mere hours from now may well be the trigger. So, what's the ECB going to say and how does it look? The expectation is that the ECB will deliver 85 basis points in rate cuts this year. That's been watered down a little bit from the 150 or so at the start of the year, similar to what we saw from the Fed. And of course, that makes sense. The Fed generally is the pace setter for global interest rates writ large, not just in the US. But we can see here that we're looking at 3 cuts and about a 60% chance of a fourth. 3 would be 75, 60% chance of a fourth at 85. So that's the baseline. And we can see that hasn't really much moved in recent sessions. About a week and a half now, we've been hovering about here. If you look at the timeline based on rates implied in ESTR futures, well, what you find is the first cut really shows up in June. So you get from 4 down the first 25 basis points by June. So that's the first cut. Then in September, the next step down to the 3.5 happens by September. So you can see here we're already a little bit shy of that here. And then by about October, December is where you get one more cut. And of course, there's the optionality here for the fourth. We're not quite down to 3 or below, but we're starting to kind of veer toward perhaps that's the path of less resistance. At 60%, the odds of a fourth cut are better than even as it were. If this is how we're going to proceed from here, then it seems the ECB needs really to start to set the groundwork now. It's got a meeting that's coming up this week. It's got another meeting in April. It skips May, and then it's got to go in June. So if it's going to basically say in April, we're very likely to cut in June, so as the markets don't get overly surprised and volatility is not overly aggressive, it's got to start to float that narrative shift now. So far, although the markets have been calling for ECB rate cuts, I mean, we can clearly see that here, the ECB, for its part, has not taken the bait. They've been saying, various policymakers, the majority of policymakers, and of course, most critically, ECB President Christine Lagarde, they've all been saying, we're in a higher for longer mode here. We expect that we've already reached the peak in rates, so we're probably not hiking at this point. We expect that we're done. But we're going to hold rates here for a while. So don't get your hopes up on rate cuts anytime soon. The markets, for their part, are saying, ha, 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 very funny, you're going to go in June. And then you're going to go again, and then again in the second half of this year. So if the ECB is in fact going to do as the markets anticipate, now would be the time to change its tune and begin to confirm, yes, you're right. They're not going to be obviously very explicit, but they do have to start to kind of put the feelers out there, much as the Fed did in November and December of last year, where it started to say, yes, okay, we don't feel we need to hike anymore. Yes, okay, we feel now is the time where we need to start to think about cuts. We're not ready to cut, but we're starting to get there. That's sort of the messaging that the ECB now seems to be running out of time to begin delivering if it doesn't deliver it here. So the chance that it starts to pivot seems significant. And indeed, why should they not? Inflation is steadily climbing down. It came down to 2.6% year on year in the flash February reading. If we look at the makeup of inflation, the biggest components are still those that should be relatively amenable to further disinflation. They seem to be mostly on autopilot. We can see, in fact, that much of the recent stalling in this has been about the diminished negative influence from the housing, water, electricity, and gas component, which of course is energy. And we know that when Russia invaded Ukraine, there was a big effort, especially in Germany, but really all around the Eurozone, to introduce subsidies on the expectation that Russia's move would significantly disrupt energy prices and cause a spike. Now, that spike ultimately was not sustained. It was a brief spike, but nevertheless, we had subsidies that were altering the price dynamic for energy, and then those subsidies expired. So their influence is now being essentially faded out of year-on-year calculations. So it skewed CPI, and now that skew is coming out of the year-on-year comparison. So the numbers are rebasing, as it were. And so as that happens, you can see the negative influence from this is fading away. And that's really why it seems we've stalled here a little bit. But as the influence fades, so too it seems like the pop in CPI is very quickly reversing back around. As far as the big contributors here, obviously food is still the biggest, followed by categories that are generally of the discretionary spending flavor, which should make them amenable to slowing economic conditions. We can see the breakdown here. Here's food. It is by far the largest contributor still. And everywhere else, that is of note, other than this miscellaneous grab bag section, seems to be of the discretionary spending variety, like hospitality, recreation. Everything else, very muted. So if you look at that and consider, well, how likely is it that these components are going to continue to move the ECB's way, the landscape seems fairly benign. We've looked at this before, and we'll look at it again. This is the transmission mechanism between global food costs and CPI. You can see here that if you take CPI and you lag it by about 7 months, you get a sense of food costs line up with CPI with about that level gap. So since you have now more months of UN food price index declines in front of you, you might reckon that it will continue to feed into CPI over time, over the coming months, and continue to push CPI lower, much as what you've seen right here. You see these food costs have been gradually fading. So too have restaurants and hotels. So too have recreation and culture. Now, for those two, and really for all of the kind of discretionary spending components here, the main kind of concern ought to be that the economy remains in anemic shape. This is the latest update on Eurozone PMI numbers. As ever, 50 is neutral, above 50 is growth, below 50 is contraction. We can see here that services returned to neutral, but that the overall economy, the composite index there in the dark blue line in the middle, that remains in contraction mode under 50. The pace of contraction has eased back a little bit, so it was contracting faster here when it was further below 50 than here. But nevertheless, contraction continues, which should hit the kind of discretionary spending categories that account for the rest of the inflation sort of outsized pockets. You should see that as the economy continues to remain weak, that you get that spilling over into overall diminished demand for those things that are, as it were, optional. Hospitality is one. Obviously, recreation is another. So it seems like the ECB has the ingredients here that it needs in order to say, we think inflation is going to get to where we want it to go. And the markets seem to agree, because if you look at what is being priced in for inflation expectations in the benchmark rates, what you find is that Germany's break-even rate, this is the difference between nominal and real interest rates. So you take the nominal German rate, in this case, the 2-year rate, so that we stay within kind of a relevant policy window for the ECB. And you say, okay, so they need to get inflation to 2% over the quote-unquote medium term. That's what most central banks usually target. And the only central bank to really define medium term explicitly, at least in its research, if not in its communication, has been the RBNZ, actually, the Reserve Bank of New Zealand. And they kind of guesstimated that it's about 2 to 3 years. So that's kind of the general logic for what is a forecastable policy window for central banks. So you figure, you look at the German 2-year and you say the nominal rate minus the inflation adjusted rate gives you the magnitude of the inflation adjustment that the bond market has priced in. That's the break-even rate. What you find here is that it is now anchoring below 2%. Now, in fairness, Germany's economy is weaker at the moment than some of the things you see, for example, in Southern Europe. But in that it's anchoring below 2% at about 1.7, and this is the largest economy in the Eurozone, tells you the regional number overall is probably something with a little bit of a premium for outperformance in some of the other regional economies, is going to look like maybe like 1.8, 1.9%. Even if there were a premium markup here of as many as 30 basis points, you'd basically be at the ECB target. And so it seems like the ECB has convinced markets that it's done enough, and all the evidence inputting into the calculus, be it inflation numbers, be it economic growth numbers, anemic as they are, all that seems to confirm that it would be perfectly fine for the ECB to justify a rhetorical shift here to set the stage for rate cuts. Now, if that's the case, we end up with the European Central Bank locking in what looks like the most significant rate cut cycle of the majors. You can see the Reserve Bank of Australia is expected to cut less. Bank of England is expected to cut less. The Fed, the Bank of Canada, and the ECB seem about clustered around the 80 basis point mark. And it's the ECB that's seen doing the most cuts by a slight margin. But that's not really the most dramatic chart here. This one is. The peak in rates being locked in by the ECB, if it firmly starts to cut here, will be lower than every other major central bank counterpart that we have here. Lower than the Fed, lower than the BOE, lower than the Bank of Canada, lower than the RBA. And that, of course, is something that is going to put the euro at a significant yield disadvantage. So, coming back to our chart here, if this resistance holds in the 109.21, 109.51 area or so, and we get the reversal, the first key level to look at would be essentially the 108 figure. But signs of exhaustion here might well offer an opportunity even to trade that move if the reversal signal actually occurs. After 108, it's not a long ride into 107, and then below that is where the real meat of a down move might begin. And of course, about 109.50 becomes invalidation. So if you got north of that back into this area up here, in and around 110 or so, well then something else may well be going on. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what is likely to happen thereafter. I am usually back on with Chris for Futures Power Hour on Friday, but not this week because we're making some incredible improvements in our studio setup here at tastylive. So expect things to get very cool and fancy from here. But we need to do some technical stuff on Friday. So Futures Power Hour on hiatus this week, but back the week after. I'm also on with Tom and Victor for First Call on Sundays, writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.